Good afternoon, ladies and gentlemen. I am aware that I'm probably the session before you get to go home or enjoy wonderful Cape Town. But regardless, I'm going to make an effort to keep you engaged in the last session. And in that regard, I'd like to present a little bit of the unique offering of UNCDF. So UNCDF is the United Nations Capital Development Fund. In that regard, we're a relatively small UN agency, but we are a very unique UN agency in that we are one of two agencies that have got a lending mandate. The only other lending mandate is IFAD. And IFAD fundamentally is a rated entity. And as soon as you're a rated or credit rated entity, concerns around risk appetite kicks in, because you need to be able to raise funding in the commercial market. Now, UNCDF is 100% donor funded, and that means we are able to use our financial instruments, so loans and guarantees, and go in the more risky markets. And we sometimes can be the trailblazers for other entities like DFIs to follow in afterwards. So in that regard, I want to specifically touch a little bit on UNCDF's risk appetite that's uniquely designed for these challenging markets, and then speak a little bit about our products and where we go and when we go. So just flagging a little bit the spectrum of different risk appetites and who plays where. So if we set out a target audience, which for us at UNCDF is least developed countries. So these are the most challenging of the challenging. We typically think of countries where there's political turmoil, challenges throughout Africa. Myanmar is one of the markets that jumps to mind. Burkina Faso, some of these, let's say, more challenging markets, all the way through to Afghanistan. And in that regard, we at UNCDF do not shy away from that risk. We are actually sometimes the trailblazers for people to follow from there. Myself, I've spent most of my career within development finance institutions. And in that regard, even the DFIs reach that certain level or that certain point where, unfortunately, they do no longer have risk appetite to support those markets. And really, this is where UNCDF tries to come in and play that intermediary role to kind of encourage further investment. So if you have a look at the slide, you've got MDBs that typically play up to the single B rating, but that's then typically when risk appetite runs out. Now, for us, going into the C markets is a place where most of our portfolio plays in. So which instruments do we use, especially in the context of reducing ODA? So this is a fact, whether we like it or not. ODA is diminishing. And in that regard, we want to really stretch that bang for buck, the ODA bang for buck, as far as possible. And what makes UNCDF unique is that we've got additional instruments, not just the traditional UN instruments of grants that you deploy in TA, that you deploy once and it's done. We have revolving instruments. And in that regard, we typically consider how can we stretch that ODA dollar or euro or yen as far as possible. So whenever we intervene, we start off to look at what's missing in the market. Why is the theory of change not happening? What's broken? So we start off with what's missing in the market. And we've stretched this now out. So first and foremost, we look at the market, and in the event that it's risk appetite that's missing in the market, well, a more efficient instrument than a grant would be a guarantee. So specifically, we then consider a guarantee operation with a local institution, a local financial, be it a development bank, be it a local microfinance entity. Can we encourage them to, let's say, get across that perceived risk burden? And we provide a guarantee. This is typically considered least subsidized interventions because you're only addressing the credit part. From there, we move on in terms of lending. Now, in some markets, it's not just about that there's a risk appetite that's missing. In some cases, you've got financial services providers that are tackling a market, but they are not able to raise funding in the local markets. Banks do not want to lend to them. And that is a space where we then typically intervene with local currency loans to the financial institutions. And typically we consider this a little bit more subsidized because, of course, now you're deploying the capital and you're exposed to local currency risk and credit. These interventions typically make up UNCDF's intermediated roles. So that is working with local financial institutions and building their capacity to address the market failure or the market challenges. Now, in some of the markets, so perhaps if I take an example of a guarantee, so we've worked in Uganda where we are targeting refugees. Now, oftentimes a refugee would be in the market. They do not have collateral. They struggle to get access to finance, but they are oftentimes thriving sectors of trading and buying and selling because people are living. So we've provided a guarantee there to kind of breach that gap of collateral and really supporting refugees in terms of access to finance within that context. Moving up to funding. So in Myanmar, which is a particularly challenging market, where we had worked with a group of microfinance entities, and we've provided funding in local currency, term funding, so that they can on-lend into the market. So specifically speaking to what was missing in the market, they had risk appetite for these MSEs and micro businesses, but they did not have the required liquidity. The banks would not lend to them. So those are kind of examples of where we work with the local sector. Now, in some cases, despite the best effort to work on the local financial institutions, it's still missing. One of the recent examples that I'll touch on, we try to work with the banks, but the banks, regardless of a line of credit or guarantee, would still not intervene in a specific sector segment. And then we need to intervene directly. And this is then when we would move to single loans that we provide to companies and projects in that regard. Now, once you intervene directly, obviously the risk goes up. And the level of subsidy or the level of cost to ODA for us also increases in that regard. And it's for a number of reasons. One, because you typically provide local currency, and some of the markets that we support, currency devaluations is quite high. The other considerations is also you providing a loan to a company. Oftentimes there's not collateral. So these are typically higher risk propositions, and therefore your default rates would also be higher. Perhaps one example where we worked with UNICEF, where they wanted to increase their local suppliers within the country so that they could acquire more in essence, nutrition supply for children within the context of Nigeria. Now, the expansion requires typically long-term capex, and these companies oftentimes supply, so it's a very concentrated client, i.e. if a UN agency buys it, a traditional bank would look at this and say, oh, but your clients are very concentrated. What if the taps close? So your proposition is very, very risky, and therefore we're not ready to support. However, you want more local capacity so that there's a sustainable source of food and nutrition. And in this regard, we supported with a loan to a company within the context of Nigeria to actually establish local of the food source that will often will be offtake by UNICEF in that regard. Now, from there, it's true that certain business are too early stage, it's too greenfield, it's too uncertain to really impose a loan. Because again, if you provide a loan to a counterpart, there is a strong assumption that you make that there will be cash flows that's relatively fixed and predictable to actually be able to service the debt. And unfortunately, that's oftentimes in this very early stage risky propositions not the case. And this is then where you need to consider, can we intervene with a grant-like instrument? Now, again, if you play a pure grant, it's out once and that's done. But in some cases, these businesses do make sense. There will be a success rate, maybe not a 70 or 80% success rate, but maybe a 50% success rate. And this is where UNCDF then wants to deploy and be able to recoup it if you are successful, so that we can redeploy and take a chance on the next business. And in this regard, we are particularly looking in the context of DRC currently, where it is particularly risky and the predictability of future cash flows is quite uncertain. However, there are a number of businesses that are doing really good in the local context. So we are looking at a couple of projects where a contingent grant or a reimbursable grant to support their working capital and seed capital needs probably addresses their need with a likelihood of paying back, but not a necessarily explicit obligation as in the case of a loan. Then we get to a pure grant play. Now, in some cases, there is I'm going to use an example where we worked on the Tanga water bond, where we supported the local water bond to actually be able to raise a water bond in the market. So we invested a lot of the development work. We paid it in advance to set up a structure so that the local utilities would be able to raise funding, but it doesn't impact on the sovereign debt exposure. These kind of development works where we provide technical assistance is very, very difficult to have a recoup mechanism, but you do get oftentimes a 10 or 20 times multiplying effect. And in that regard, UNCDF invested in the form of a grant and technical assistance, which was able to subsequently raise $20 million from the local capital market. So these are typically the interventions. We start off trying to support a sector by addressing the local financial institutions and how can we fix that. If that's not available, we move to a project side and we directly intervene. So this is really UNCDF's unique mandate to support various development activities, but really within the form of a loan, a guarantee, or a reimbursable grant intervention, as opposed to the traditional pure grant play. I'm happy to take any questions, and I hope it's been a little bit insightful of what makes UNCDF particularly unique, both in terms of a traditional UN agency, so these additional reimbursable and financial instruments, but also within the DFI space, where we can come in early interventions and try and crowd a subsequent round of funding from a DFI or an impact investor. Thank you very much.